Good morning, everyone, and welcome to the monthly economic briefing presented by the Kenan Institute of Private Enterprise at UNC Kenan-Flagler Business School. I'm External Affairs Associate Rob Knapp, and it's great to have you with us this morning. First things first, happy birthday to us. It was a year ago in May of 2022 that we started these economic briefings. It's been an interesting and enjoyable experience for us. I hope it's been an informative experience for you. We started last May with our chief economist, Gerald Cohen, and my colleague, Mackenzie Babb, doing that briefing. We've had a lot of folks participate. We appreciate you all participating as the audience, and we look forward to seeing you the first Friday of every month as we enter our second year. So we're here to talk about the jobs numbers, and there's a very interesting jobs number to talk about today. Another theme that's extended through this year of briefings that we've done has been the Federal Reserve, what they're thinking, what they might be doing, what they've done. Well, the Fed met this last week. On Wednesday, they raised the interest rates again by another quarter point. So that will once again be a theme that's returning for us. Also returning for us is Kenan-Flagler finance professor Christian Lundblad. He will be on in a moment to give his analysis of the jobs numbers of the Fed and plenty of other things. So stay tuned for that. First of all, I'll give you a little rundown about how this goes. Christian's analysis will go for about the first 15 minutes of the show. After that, we will take your questions, as we always do. If you've got a question, you do not have to wait till we get to the question and answer period. You can go ahead and submit those now. There's a question and answer function at the bottom of your screen. Go ahead and use that. Let us know what you're thinking and what you want to hear Christian talk about. If you're joining us by phone today, you can go ahead and email me your questions. And I am at rob_Knan-Flagler.unc.edu. We do give preference to questions from the press. So if you are one of the media folks covering us, please give us your organization and title with them when you submit your question. We usually go about 30 minutes with these things, so we will try to get in every question we get if at all possible. So keep them coming, and we appreciate your participation in the broadcast. All right, I've made it through the interview. You have survived the interview, so I think we're ready to get to the main course. I'd like to introduce Christian Lundblad back to talk about what was a unexpectedly big number from the jobs report this morning. So there's going to be plenty to talk about. Christian, the floor is yours.
That's great. Thanks very much. And very happy to be back doing this. It's my turn to go, and I'm really happy to share my thoughts on sort of an interesting report this morning. So let's start right here. Here's what we just learned at 8:30. And we got what was a pretty interesting read on kind of overall job creation. So well above what markets were expecting, although it is a little bit more nuanced in that there was a significant revision from the previous month. So on net, that is a slight wash, if not even a slight negative. But nevertheless, I think this is a beat from that perspective, and it certainly it should be read as such. In addition, we also saw an uptick in average hourly earnings, and I want to talk a little bit more about that, as well as some move in the unemployment rate, which was unexpected. We were looking for an unemployment rate of 3.6% going into this, and actually this is going to be well below that in the direction that I think is complicated. Let's put it that way. So this is kind of interesting things going on. I mean, this has basically been, despite sort of the complexities of this month versus last month, it just seems to be the case that in almost every month there's kind of a positive surprise in the labor market. And I think it's a testament to the extent to which there is still some robustness there and tightness. And that's good news for some, but it's complex for others. And that's kind of what I want to dig in a little bit on this morning. So here is our kind of headline number in terms of non-farm employment growth. And you can see indeed that has been trending down to some degree, although the most recent read, as I said, was positive and more so than it was anticipated going into this morning. But the reality is like this can't operate at this level forever. I mean, at some point there's going to have to be some significant moderation over here, and despite the slowdown, the labor market just continues to exhibit some interesting growth. This is going to be a question then going forward of what this would have to look like in order for the Federal Reserve to realize what I believe are its intentions in terms of trying to carefully moderate the economy to deal with the inflationary pressures that nevertheless remain. So let's talk a bit more about that in a moment. Nevertheless, this is a sort of a positive surprise, certainly, and is again just commensurate with what we've seen, for many of the months over the last year plus or so. Second, here was really, I would say, something of a surprise coming from the household side of the survey, and that was the unemployment rate edging down, actually, where we actually imagined that there was going to be a slight uptick as a result of the work that the Fed has been doing, to try to moderate the economy and their rate hikes that have been seen over the last, over the last year plus. So, on balance, this continues to be, I would say, a strong job report. And if you look a little bit under the hood, and where do you see some of the job growth? It's reasonably broad-based, and indeed, in some of the places where we've been struggling to find some of the growth we might have wanted, so in more the services side as well. And so this is not unique to any one pocket of the American economy. It's reasonably widespread, and is good news in some ways, as I said, certainly for those who are employed, but it is very complicated along some other dimensions, and so that's going to be an important topic. I want to highlight a few more things from the labor report as we go through, but I do think it's important to acknowledge that we are getting other signals. So if we look at job openings, which has been a really interesting number, that comes from a different report that is given at different frequencies, and we saw this a little bit earlier. We do see there's some decline here. So you can see in the most recent reads, this has been starting to fall off. That has been something of a puzzle, to be very transparent. In terms of the number of job openings out there relative to the number of job seekers, this has just been at historical highs, at least relative to the extent to which these kinds of numbers were tracked. And so to see a little bit of falling off there is sort of necessary, as I would say, to try to balance this health of the labor market versus the inflationary pressures that are there. And so there are other signals out there that are suggesting some potential for at least a bit of softening. And so just take this nuance, like what happens from one data item is just one piece of a very broad picture, and this is indeed just another read that is giving us perhaps a bit more of the contours of the problem. So I want to interject that. I do think I have to come back to something that we've been talking about here at the Institute for a long time, which is kind of where are the laborers to some degree. And so if you think about, the tightness of the labor market, one of the interesting components has actually been just on the labor supply. And so in the orange here, what you see is labor force participation. And that is for prime-aged workers, folks that are in the age group of 25 to 54, and that has largely bounced back. And we've been making this point, for some time. You can see the remarkable sort of dislocation that happens around COVID, and then the recovery at the very tail end of this picture. But what is not the same, and indeed just has not bounced back in any way, if you look at the mirror image of that in the blue, which is kind of overall civilian participation across the entirety of the American economy, that just hasn't bounced back. And when you sort of look at that gap, you're looking at a lot of workers, and a lot of workers with very particular skills that have, that are in increasingly short supply. So if you think about certain, welders and plumbers and specialized truck drivers and other folks that have sort of left the labor force and are very likely never coming back. And those are the demographic shifts that are happening in terms of the baby boomers and early retirement choices and all of that just weigh significantly on participation. That's just a tremendous headwind for the labor market to kind of equalize and then to maybe take some pressure off wages. And I would just make a side note, which is on the parallel to that. How else can we feed the labor supply? Well, that happens on the immigration side. And while we have seen a little bit of recovery post-COVID on immigration, it's still very difficult for a whole lot of complicated reasons in this country to bring in all the laborers that we need from the outside, despite their perhaps natural proclivities to come. And it's, for example, really hard to bring skilled labor in this country relative to an earlier time. And so while there's been some recovery from the nadir of COVID, we also aren't helping to solve this problem, neither sort of internally with a lot of Americans choosing a retirement, but also, from an external standpoint. And so this is a big part of the problem. And the participation rate that we saw in the most recent read here was pretty flat. So that hasn't fundamentally changed, over the last month either. So that's an additional component. And so when we think about some continued strength in the demand for labor, even if the job openings have fallen off a little, and we continue to see this, sort of dearth of workers, or at least some subset of them on the supply side, then what's that doing? Well, it's continuing to put pressure on the price of that resource, and the price of that resource is wages. And this is the crux of the problem, in my opinion. So a big part of the challenge that we continue to face are tightness in resources, various resource costs. Labor is a big one. And so to the extent then that we continue to see wage pressures, that's going to create, all kinds of complicated effects for things to which the Fed has no choice but to respond, right? So average hourly earnings were up surprisingly in this read. So I think that's the single most important number, in my opinion, because that's the one that is then really potentially having, a big impact then on what that's doing to inflationary dynamics in complicated ways. So averagely hourly earnings were up; they were above expectations, and kind of over the last year, so year on year, 4.4%, and that's an increase relative to perhaps where we expected. And so that means a lot of different things. One is inflation adjusted earnings are much smaller than they are in sort of nominal terms, but it also creates these spillover pressures that firms face. And again, when firms are struggling with their labor budget, they try to pass some of that cost on to their customers to the extent that they can, to the extent that their competitive environment allows. And that's where we start to get inflationary pressures that are widespread. And so there are lots of different ways to read this. So this is the one that we just learned this morning. Again, a bit higher than we anticipated. We also see from a different report another measure of employment cost. And while that one's showing a little bit of moderation, it still continues to be, pretty elevated, in the ballpark of 5% per annum. So if you take it on an annualized basis. And so the employment cost index is another alternative read on this. It's a little broader in the sense that it picks up some other employment cost things that find their way into the labor budget of corporate America. And so you sort of put these together, and you can kind of get a feel for the extent to which there's still some wage pressures. And again, that's not a bad thing. I mean, that's Americans getting paid for their service, but it's the economy is complicated, right? And so to the extent then on aggregate, that creates pressures for firms then to have no choice but to pass some of those costs on to their customers, then that's where we get inflationary pressures. And so it's not anything but that in a way. And so we ought to appreciate that. And so overall inflation then does remain stubbornly high. So here's one measure, which is the PCE, stripping of some energy and agricultural food costs, and we could look at CPI or PPI or other measures, and we simply see the extent to which broadly across the overall economy there do remain some very complicated inflationary pressures that the Fed has no choice but to monitor and ultimately to potentially respond. And of course, they've done an awful lot, and so the question is very much what they will continue to do in the meetings hence, and I'll talk about that in just a moment. But just understand this. I mean, it's complicated. Like what's driving inflation is still quite puzzling. I mean, it's still related to things associated with, the spillovers of COVID and all of the disruptions that we had there. Some of that is obviously, going by the wayside. Some of that remains. It's still related to some of the challenges of important resources like energy and global conflict, although that has significantly moderated. And indeed, interestingly, you'll actually see kind of headline inflation numbers falling more rapidly than a core number that does not include that reduction. But there's still this wage price question. And so, look, I don't profess to know what the weights are on those three things. I just don't think we know, but there are weights on all of them. And the third one is really important. And so this kind of feedback effect, and anyone who's managing people, I do it myself. You see the demands for their wages to be then moved in line with the inflationary pressures that their own households are facing, and you can kind of get this sort of spiral. And so that is that's something that is really important, and one must pay attention to that. And that's indeed exactly what the Fed has been doing, right? So we learned earlier from Rob that the Fed indeed raised the rates on Wednesday. And then the question going forward is, okay, so are all of these different moving parts sort of moderating in the right way so that the Fed might, signal a pause going forward? And I think, it's a little bit TBD. And in fact, it's maybe a little bit more complicated than that. It's kind of, pick your poison. So the question that everyone is asking in the background of this is, in moving so very rapidly, and you can see the rate at which the Fed has accelerated in its inflation fighting here, there have been some significant disruptions in our banking system. And so that has been costly for the, for regulators to deal with. It's been, there's been an opportunity for some consolidation that we might not have otherwise wanted in the banking system. And there are lots of questions remaining about the health of certain regional banks going forward. And you can even look at financial markets today, and there's a lot of volatility in some of that space. And so the issue is, in moving so fast, is the Fed kind of breaking something? And then that's ultimately going to have some significant spillovers on lending and credit allocation and the ability of firms to move forward and to really, really endanger the economy going forward. Look, another way to view that is, if that really does start to slow things down in some way, and it's not too awful, that actually helps the Fed do its work. In some sense, like there's sort of a mapping between a slowdown in credit allocation and kind of an increase in interest rates, if you think about that intellectually, and so in a way, it's a little bit like pick your poison in some sense. Do we need to have some, challenging, credit environment so that we can have some slowdown? Or if that really is not the first order effect, and the banking crisis, or whatever we want to call it, is sort of relatively isolated to a few, and it's not really going to permeate more broadly and become systemic, well, then that means that the inflationary dynamic still remains, and the Fed is still going to have to operate in its traditional way along some other dimensions, including their traditional ones like this. So in either case, look, the reality is we have to find some compelling ways to try to slow this down a little bit. The optimal way is one in which we sort of moderate the employment growth. We slow down a little bit the borrowing that's happening in some places. We do it in a way that facilitates a kind of nice soft landing, and then the inflationary pressures come off a bit, and maybe the unemployment rate comes up a little bit, but it's in a way that's long run sustainable, and that's the sort of Goldilocks outcome. I remain skeptical that that's going to be feasible, but in either case, the Fed is going to have to continue to fight on inflation at some level. And so I think a report like this only suggests that, hey, look, there may be a pause coming, but this is what I think the market is struggling with, which is there may be a sort of plateau coming in Fed policy, but then the question is ultimately then about the persistence of Fed policy going from there. And the market is imagining some things that I think are a little bit of a mirage. So if we look at something like the spread between longer term dated treasury contracts, so long-term treasury bill bonds and bills, bonds and notes, and short-term bills, the yield curve remains still remarkably inverted, which means long-term rates are quite low relative to these shorter-term rates that kind of reflect where the Fed is right now. And so in a way, it's intellectually imagining that someone is sort of baking in an expectation that the Fed is going to be cutting rates over the life of that long-term bond, potentially in some rather compelling ways. And indeed, that's baked very clearly in Fed funds futures contracts. So this is a market that is trading, which is basically just a bet on where the Federal Reserve is going to be in the months hence. And so I just wanted to show you this, and then I'll show you two more pictures, and then I'll wrap up there. So what is this? Well, this is the Fed's own signaling about where their policy is going to be. It's the famous dot plot now, and each one of these dots over here represents one of the decision makers on the committee that is going to help kind of ascertain where their policy ought to be. And so if you look at the end of this year or the end of next year or the year after, you can see a few things. One is, some expectation about where each of those decision makers thinks the Fed is going to be. And as you get out into the out years, you can see there's some disagreement. But I want to contrast that with the red dot, which is what's coming from financial markets. And so what's coming from financial markets is coming from the federal funds futures market. And the Fed funds futures market, for example, is imagining that the policy rate is going to be significantly lower by the end of this year, and quite a bit so as we get into the out years. They're anticipating that, okay, so maybe the Fed is kind of plateaued, but again, commensurate with that yield curve, the Fed is going to actually start cutting rates. Why? Because they think, maybe the narrative is turning. The banking crisis is going to be, a real crisis. And then, maybe we're actually going to start to see some significant increases in the labor market, in unemployment in the labor market, which we're not seeing right now. And so let me show you two more, which is actually exactly where this market is anticipating the Fed will be in a couple of meetings hence. So this is our next meeting. This is the Fed's next decision-making point. And what you can see over here in the darkest blue is where that market is trading right now after this report in terms of where they think the Fed is going to be in the next meeting in June. And then as you get to the lighter colors, you can see kind of where that market was thinking yesterday, last week, and last month. And so what you can see is sort of a consolidation of the idea that maybe the Fed has paused now and it's going to kind of sit at that 500 to 525 basis point over the next meeting. But here's the last thing I'll show, which is, again, this idea that at December's meeting, so year end of this year, you can see the darkest blue is shifted well to the left of where we are right now. Again, remember, after Wednesday, we're sitting, at about 525. And you can see it kind of relative to, again, where we were yesterday, where we were a week ago, where we were a month ago, a lot of firming up in the idea that the Fed is going to be cutting over the next year. And I'm having an intellectual discomfort trying to put all this together in my mind. So I do think it's very likely that the Fed is sort of approaching the plateau point. But every read like this, including this morning's, where just continues to show different dimensions of the challenges of tightness, not really waning. I think it's very hard to imagine that it's going to be easily the situation where the Fed is going to have to start massively cutting in a way that is exhibited in sort of expectations like this. So I do think we may have a challenging economic environment going forward as the Fed tries to navigate this. But the piece that is hard to imagine going away very quickly in my mind is the inflationary pressures. And so then you have to intellectually ask yourself, would the Fed really start doing rate cuts like this, even when it's the inflation rate it's observing is well above 2%, it's kind of presumed target? Or would they really manage to make some massive headway on that inflation rate, and the labor market really starts to sour in a way that is not being exhibited in the employment reports we're seeing? So this is the challenge right now, is in some sense trying to put all this together. And I think the really important piece that gives me some concern over here is not sort of the slightly mixed view of where were we last month versus this month. It's the resource cost price that continues. So that's there. The inflation problem has not disappeared.
All right. Thank you very much for that analysis, Christian. I sometimes feel like we run a quiz show for economists here, where we hand you a report with a top line number that looks nothing like it was supposed to, and then we give you 30 minutes to come up with an analysis. So you're definitely the winner on today's show. That was great. Folks are interested. They have questions. If you have a question that you haven't sent me, go ahead and use your Q&A function at the bottom of the screen. Or if you're with us by phone, you can send me an email at rob_knapp@kenan-flagler.unc.edu. We will go straight to the questions. Lauren Onesorge from the Triangle Business Journal says, how should Triangle area CEOs be thinking about these numbers?
Yeah, so the interesting thing is this area is still doing pretty well, right? And so we've been one of the beneficiaries of some really interesting migration and Also, a lot of really interesting growth opportunities across the triangle. So I'm not in any way kind of pessimistic from a regional standpoint. I don't want to express that at all. I just think in the background, there's going to be this narrative of some continued uncertainty about, maybe not how much higher the Fed will go, but how much longer it will go. And so if that means then that, Fed, rates will maintain some degree of flatness, that means borrowing costs will continue to be challenging for every firm. So even in a place like ours that has, a lot of things going for it and a lot of tailwinds that are in the background that are helping us, it is going to be the case, I think, that the borrowing environment is simply going to be more complicated going forward. And so that's something of a headwind that I think everyone in corporate America is probably going to have to continue to digest.
Okay, very good. Lauren and Dan Barkin at Business North Carolina, I think we're both interested. You talked a lot about what the expectation is for what the Fed will do with interest rates. I think they were both interested in where your money was on what the Fed will do at its next meeting.
Yeah, so I think the next meeting is very likely to be flat. I mean, unless something really weird comes in on inflation, which we'll get at least a new CPI read, a little later this month. I think they're likely to be flat. The disconnect that I see with the market is not necessarily how much higher the Fed is going to go, it's how much longer the Fed is going to stay where it is. And so if inflation proves sticky, in order to realize the kinds of cuts that some in the marketplace seem to be pricing in, they would have to be ready to really start cutting in the face of a banking challenge or a real increase in the unemployment rate, where an inflation is well above anything that they would view as optimal. And so it's just hard for me to digest that. So I think it's, the question really is not how much higher, but how much longer.
Mm-hmm. Okay, David Hill at the Triad Business Journal says, what, if anything, do you see in details regarding manufacturing employment?
Yeah, so we saw a little bit of action over there. So over the entirety of the U.S., it was up a teeny bit, but I think clearly the goods part of the economy and the interesting part of the growth there over the last several cycles, that has not been as strong as the challenges that we've been facing on still dealing with kind of a labor shortage on the services side in a way, right? So that's really where a lot of the post-COVID demand came. And so, again, I think there's a lot of regional stories here probably that sit below that. And so I think in this report, there's nothing distressing along that dimension, and nor is there anything particularly exciting. But sort of holistically, there has been, I think the acute challenges that I'm talking about in the labor problem are outside of manufacturing primarily.
Okay, thanks. A couple of people asked about the big revision to the number from last month. Is there anything for us to take from that, and why does that happen?
Yeah, well, so sometimes that happens. Well, look, government bean counting is an inexact science. Let's be very clear. Number one. Number two, we do get revisions, and we get some things that are statistical artifacts. So there is an effort also by the bean counters of the world to try to remove seasonalities and other sorts of things that we don't really want to ascribe to anything interesting from an economic standpoint. And so sometimes those over adjust. So I don't know what exactly the reason was here for kind of a surprising big move this month and a negative shock last month. So I think a good thing to do is to sort of take a 2, 3, 4 month moving average or something, and kind of get a sense of, once we strip out some of the revisions and some of the statistical artifacts, kind of what's the broad trend that we're seeing. And I think the broad trend that we're seeing is indeed a kind of moderating growth, but it is still nevertheless one that is kind of hard to reconcile with where we think the Fed might want to go. Like, if the Fed really wants to see an unemployment rate that's a little bit north of where we are, over the next several meetings into the end of the year, we would have to see job growth that is significantly smaller than what we're seeing, at least, in terms of these over several month moving averages. And that's a really different setting from where we are right now and what we learned this morning.
Okay, let's see. This might be our last question at this point, but Rob Interiano says, main takeaway is that the market will likely need to adjust since their current expectations seem overly optimistic. If the market adjusts, how will this affect the already fragile banking sector, especially small banks, as well as financial institutions?
Yeah, I mean, this is a challenging setting in a way. So, what could that mean? That means then that there's I guess some challenges in terms of what's on their asset side. That's been kind of the problem for a lot of these guys. Like, what do they own? What kind of lending have they done? What kind of exposures do they have from an interest rate setting? And so that will be different things for different banks, and indeed all the banks that we've heard about in the space so far have kind of different stories in terms of the interest rate exposures that they're facing. But I think the reality is the following. So if it is the case that the Fed is going to be sort of there for longer, and that's my hunch, that means a couple of things. One is the short-term rate will be elevated for longer than I think some anticipate. That's a challenge for some banks in terms of their deposit side, meaning that they've got to offer competitive rates, or they start to continue to lose additional deposits to money market funds and others. And then on the other side of the equation, that means then that longer term interest rates are going to be somewhat higher if that presumption is right. I mean, so again, seeing long-term rates be so much lower than the short-term rates sort of presumes that the short-term rates will be decreasing over the life of the longer term object. And I'm just struggling to see how that makes sense in a way. And so that's sort of the idea that the Fed, the world is kind of imagining the Fed is going to be doing something. And so if those longer term rates sort of equalize, or maybe there's some kind of flattening in a way that takes place, then we're going to see a situation in which there's also going to be a digestion problem there, which is, some of the assets that they own may struggle, although that creates a more interesting and sustainable lending environment for them on a go-forward basis once they kind of get through that adjustment. So it's a little bit nuanced in that sense, but I think that's the important thing, is this really significant disconnect between where short and long-term rates that's killing them right now, and the adjustment through that would be complicated. But the back end of that actually is a much better environment for the banking system in a way.
Okay. We're a little bit over time, but since it's our birthday show, I wanted to slip this in. And also, since we won't be back again until June, debt ceiling, lightning round. You want 30 seconds on that?
Sure. Well, so you're asking me what's going to happen? I haven't any idea. And the reason is because it's mired in political nonsense. Let's be completely clear about that. And it always has been, and it has, the culprits change from time to time depending upon who's in power and who isn't. But at the end of the day, this is an absolute bit of insanity. Okay, and so just to be very clear, what are you doing? You're agreeing to issue debt to essentially pay for things that you've already appropriated, right? So this is already expense. It's like, saying I'm not going to cover my my credit card responsibilities in a way or something. So what would I like to see in an ideal world, which is certainly not Washington at present, right? What would I like to see? I would like to see the stupid debt ceiling nonsense go away entirely, because it is a complete distraction and has absolutely nothing to do with anything pertaining to fiscal responsibility. And at the same time, I would like to see Washington, Democrats, Republicans get serious about our inability to spend within our means, period, right? And so the fiscal responsibility of this nation is first and foremost, and I don't care what you care about, national defense, environmental policy, whatever is your favorite thing that Washington does that is precious to you, none of that is possible in the absence of a stable and healthy fiscal situation. And so the removal of the debt ceiling does not give anyone license to avoid that. And the reality is, like, in the background of all of this, there's some really, really big conversations that we will have no choice but to have. I'd rather we have them earlier rather than later. But that the debt ceiling has nothing to do with fiscal health. It's a weird, goofy thing that just creates an opportunity for political posturing and some danger.
All right, strong words. We'll see if Washington was tuned in today and
No,
takes
they
your
never
advice.
listen to me on this one. No.
Well, it's worth a try, right? Worth a try. Thank you, Professor Christian Lundblad, for your great analysis as always. Thank you to everybody who's watching today and who gave us some great questions to work with. You folks are always on the ball, and we do appreciate your participation. For all the media with us today, we'd love to continue the conversation. If you have questions for Professor Lundblad or any of our other experts on anything we talked about today or anything else we cover, we'd be happy to talk to you about that. You can always email me at rob_knapp@kenan-flagler.unc.edu. For everybody watching, we'd love to have you check out our website that shows the full breadth of what we have going on. A couple things of interest there. We have a new insight from our American Growth Project that you might be interested in about skills and the skills gap that just went up this week. Something else that also just went up this week is from our chief economist, Gerald Cohen. It's a commentary on the possibilities he sees for where the economy may be going in the future this year. I think you'll probably want to read that too. So check it out, kenaninstitute.unc.edu. I think that is it for today's show. We appreciate everybody being here. We'll be back again. I believe June 2nd is the day for the June, our little Friday circle up here. So keep that on your calendar, and we'll have invitations out for that soon. Thanks very much. We appreciate you being here. Have a great Friday.